Well, welcome everybody to the SlateStone Wealth 2024 Investment Outlook and Policy webinar. I am Kenny Polcari, your host, Chief Market Strategist here at SlateStone Wealth. Today, I have the sincere pleasure and honor, and trust me, it is an honor to have Ann Sonders on with us, who's the Managing Director and Chief Investment Strategist at Charles Schwab Co. She's a great personal friend of mine. She has a range of investment strategy responsibilities, from market and economic analysis to investor education, all focused on the individual investor. And she is a keynote speaker at numerous company and industry conferences. She's regularly quoted in the press, the Wall Street Journal, the New York Times, Barron's, Financial Times, and she also appears regularly on the major business programs. So Fox Business, Yahoo Finance, CNBC, Bloomberg, CBS News. She is also, and this is the best part, she has been named the best strategist by Kiplinger's Personal Finance and one of Smart Money's magazine's Power 30. Barron's has named Ann to their 100 most influential women in finance every year since its inception. An investment advisor has included her in their IA 25. It's a list of the 25 most important people in and around the financial advisory profession. Right now, one last thing. She's also been named Forbes 50 over 50. Okay, but let's not go there right now.
Thank you.
And for me, I spent 40 years at the New York Stock Exchange as one of those institutional floor brokers who ran around screaming and yelling, buying and selling all day long. I relocated down here to Florida about 6 years ago. Now I'm Chief Investment Strategist. I have the pleasure of having Ann with us. Ladies and gentlemen, please welcome Ann Sonders. Ann, how are you?
Thank you, Kenny, and thank you for that very kind introduction.
It's all yours.
It's funny, the Forbes, 50 over 50. I managed to, squeak that in before I would be eligible if they even did it for the 60 over 60. So, but we won't. We've known each other a long time, but we won't date ourselves anymore.
I saw that. I said I'm going to mention, but we won't go there. Because we've known each other for decades. Let's just leave it at that. I'm not going to go into how many. I'm just going to tell you decades. Listen, we put this out there. We've got plenty of clients on. We've got some prospective clients on. I've got a million questions in front of me. So we've got more than enough to fill up the hour. And I'm sure between you and I, we'll have plenty to talk about. So I look forward to this. So let's just start. Let's get right off to the bat and talk about, this recession versus soft landing yet again. Everyone's leaning towards a soft landing narrative, right? Given the better than expected economic growth and the resilient labor market, the strong wage growth. So talk to me a little bit about what you think and what your kind of nuanced definition of this and where you think it's taking us and what investors should be thinking about.
Sure. Let me preface the comment with, I guess the debate should almost add in these days the no landing view, which I'm not sure if I buy that with any kind of permanency. It's like, a plane. Eventually it has to land. So I don't think you have no landing. And I think a no landing scenario near term would also mean a no cutting scenario in terms of the Fed. But what we've been, the term we've been using to describe this, stating the obvious here, very unique cycle, is rolling. We had rolling recessions. Not that any of us want to rehash or relive the last almost 4 years, but you have to go back to the robust stimulus era in the throes of the pandemic, and the demand associated with that obviously pulled the economy out of the short-lived but painful COVID recession. But at that time, all of that money was funneled into the goods side of the economy, because we had no access to services. That was the breeding ground of the inflation problem with which we're still dealing. But fast forward to the more recent period, we've gone into goods disinflation, if not outright deflation in many categories. But we also had recessions in manufacturing, housing related, a lot of consumer-oriented goods and products. We just had the offsetting strength in services. So it wasn't sort of a bottom falls out all at once. You've just seen the weakness roll through. And I think there's a possibility you start to see recovery roll through. And I sometimes get criticized with the nickname of rolling, but it is what it is. That's what's happening.
It is what it is. No, I agree with you. But let me ask you a question, because you made 2 points there. One, which I think is important for everyone to understand, is that the U.S. economy is like a 75% services economy. So services inflation is actually a very key metric for people to pay attention to. That's number one. But number two, the comment you made about disinflation, maybe in some goods, where are you seeing the disinflation?
Well, again, most of the goods categories within inflation metrics. In fact, I have I think you know, Kenny, I have a podcast that
Yep,
I co-host with my colleague Kathy Jones, and just
yep,
today I interviewed a guest that is going to be on the episode that airs on Friday, and it's Matt Shea, who
yep.
is the head of the National Retail Federation. And we got on this subject, and I wish I could remember his acronym, but it was basically all the stuff sold in department stores. So it's, apparel and footwear and electronics and
Right,
household goods. All of that has gone into significant disinflation, furniture, et cetera. If not outright deflation, you've seen it in certain commodities with fits and starts, but it's the services categories, which aren't all truly what we think of as services, because the shelter components get lumped into services. And I guess they're services, but one could argue that your home or your apartment is also a good, but
right.
it's just how it's categorized. And you've just seen not only the offsetting pickup there, but many of those categories are just stickier in nature. And that's why we haven't seen overall inflation come down to the Fed's target yet. But you've definitely seen different timing around what happened on the goods side and what happened on the services side.
Right, but that then brings up the argument, because I do agree with you. You are seeing prices come down in some of those sectors that you said, but how often are you going out and buying a couch, or how often are you going out and buying a used car, right? That's really the issue. Okay, great, used
Right.
car prices came down, but I'm not buying one every month, and I can't
I
eat a
think
used
that's
car, and I can't,
exactly
right?
why there is still so much angst about inflation,
Right,
because you and I can look all day, every day at the innards of PCE or CPI or PPI, and we can talk about disinflation and month over month changes versus year over year changes. That's not how the consumer thinks about it. So I think
right,
you're right. They think about things like the rent they're paying as that's something that's every single day. They can't pare back on that.
right.
They can't adjust sort of quality or brands. And so I think that's a piece of why there's still angst. Not to mention, I think a lot of people think more about inflation in level terms, not the minutia of month over. Well, it was, last month was zero point 0.3, this month is zero
Right,
point 0.2. Yay.
right,
So
right.
plus every consumer, frankly, everybody's rate of inflation is different.
It's different.
Someone that, commutes a long distance and in a, say, in a high, gasoline price environment, fills up
Yeah,
their car. I think of my parents. They don't drive anymore. They live in senior living that has a fixed amount they
right.
pay for. Their inflation rate is almost nothing.
Oh, that's right.
So everybody's inflation rate is different.
Right, exactly. But I think what causes all the angst is that there's a lot of people like us, right, that who are not living either on a fixed income or on a fixed. But so the inflation rate, you feel it. You feel it every week. You feel it every month, whether it's utility bills, or your insurance bill, or car insurance, or food. Right, you still go to the grocery store, and food prices are still extended. Although a week and a half ago, Jenny Yellen, I'm assuming you saw the interview where she said she didn't expect price levels to come down, but not to worry because wages have gone up. And so therefore it's flat. People should not be concerned about it because your wages have gone up. So it's covered all that. So everyone should be good. I don't necessarily think that's what people are thinking at all.
Well, again, there are the metrics that matter to the Fed in terms of the reaction function, having gone from the most aggressive tightening cycle in 40 years to now being in pause mode to when they eased. So those connectivity points do matter for things like monetary policy. But I think you're
Right.
right. That doesn't mean that the average consumer isn't thinking about it in a way that's very different from how, whether
Right.
it's politicians or Federal Reserve member, and that's not a new thing. That's
No, right.
always
Right. Because
the
they're
case.
thinking about how it impacts them on a daily basis, right? They don't, you can talk all you want about what the Fed says, but everyone knows how they feel, right? When they go to the store, when they get in their car, or when they go shopping, right? So
And
it's kind
it's
of,
human nature to think of whether it's economic data or inflation data in, is it good or is it bad? For me, or more broadly, is it strong or is it weak? But there's the more subtle nuance of better or worse that tends to matter more for people in our position, trying to connect the dots between what's going on in the economy and what's going on in the market, figuring out where you are in the cycle and monetary policy reaction function. Better or worse is what tends to be the driver, but it's human nature to think good versus bad or strong versus weak.
Yeah, no, and that's exactly right. And I think that's really what hits home with, a lot of people, at least people that you talk, that you and I are talking to kind of on a daily basis. All right, so let's just move on because I want to talk. You said something, and it always gets me because we talk about the Fed, right? So we talk about how long they kept rates at zero, longer than they had to. We both know that.
Yep.
And then
they concede that.
Absolutely, no doubt about it. But then they talk about how they gave, in my mind, as we approached, 2023, and he started indicating in the fall and into the early winter that they were going to start to raise rates. And they were going to raise them, they're going to raise them, they're going to raise them. So I think everybody had plenty of warning that this is where it was going, and they were going to take it to this level. And so what was interesting, they keep talking about the Fed raised rates at such a swift pace. I didn't think it was swift. I thought it was very well telegraphed. Everybody knew it from month to month that rates are going to go up. So I'm confused, or it's interesting to me that they talk about how fast they raise rates. It wasn't fast to me.
Well, except that they did multiple rate hikes of 50 to 75 basis points. That is not par for the recent course, but it was because they were trying to tackle a 40-year, 4-decade high in inflation. Right. And they did. We can all armchair quarterback till the cows come home.
Right.
And again, Fed concedes, they probably stayed at the zero bound too long, but
way too long.
It is what it is. And I think, there's that old analogy about the full Fed cycle, where they typically take the escalator up and the elevator down. Because when they're hiking rates, they know it has a deleterious impact on the economy. They want to be methodical and careful. And then when it comes time to cutting, it's often because the economy is in recession. They're trying to pull the economy out of recession. This has been the opposite. They took the elevator up, and I think their inclination is to take the escalator down.
Well, but I actually think you're right. I don't think, at the moment, I'm in a position that I'm looking at all this data because they are data dependent. They've made it very clear they want to be data dependent. And at the moment, the data does not suggest that the economy needs stimulation by lowering rates at all.
First of all, I think even before the hotter than expected CPI report and the hotter than expected jobs report, we were not in they'll start in March camp. There was really no basis for that view. Neither of the Fed's dual mandate were suggesting they somehow had a green light to start cutting. It was supportive of staying in pause mode, but not cutting mode. So I think the market got over its skis in not only pricing in a start in March, but 6 to 7 rate cuts starting in March. Now the market probabilities have sort of caught down to what the Fed has been communicating via its dots plot, which is a later start and not as aggressive set of cuts, which, by the way, isn't necessarily a bad thing from a stock market perspective. I always say be careful what you wish for. If your sort of bullish case on the stock market is based on an aggressive Fed on the downside, well, that would probably mean because they're trying to quickly pull the economy out of a recession. I'm not sure that's a good backdrop.
No, I don't think that's a good backdrop at all. And I think what's also interesting about that whole conversation was it started after, I think, the November Fed meeting when they came out, they talked about the dot plots and they talked about how, that there were people on the committee that thought maybe there were going to be 2 or 3 cuts. Okay, but it was just a conversation. Well, it went from maybe 2 or 3 cuts to 6 or 7 rate cuts coming in 2024. And I thought to myself, where is this coming from? Besides the fact that it's a presidential election year, how are you going to cut 6 or 7 times going into the election?
I was really floored by how aggressive the assumption was for a March start. It just was not supported by the data, other than the only argument in favor of that had some, call it, fundamental merit, was that if disinflation persisted, the nominal rate was going to, stay flat, given that we're in pause mode, but the real rate would be going higher, and that would be, a tightening of financial conditions. But I didn't think that alone was supportive of such an aggressive assumption. But that's not the assumption anymore. The market did come around to reality and or the Fed's thinking at this stage.
Well, so the market, I think, is still pricing in 3 cuts. Is that what you think the market's pricing in?
That's what right now, that's what the market is pricing in. And based on the dots plot, that's what, now you have to always remind people that the dots plot is not sort of a plan by the Fed. It is not.
Agreed.
It is just each individual voting member at the
Right.
time of the meeting. They say,
Right.
here's where we think the Fed funds rate will be. And then
Exactly.
they're aggregated into the dots. But
Yep.
it's as good a guide as any. However, the big difference is the Fed in past cycles has telegraphed what their process is going to be. This time, they are very adamant about data dependency, which means it's not like the Fed has some sort of preconceived notion of what they're going to do, and they're just trying to decide when to drip out that information to us slowly, Fed and market watchers. Data dependency is legitimate, which means we're all at the mercy of every data point, and that will continue to move the needle in terms of probabilities.
And I agree with you 100%, because we had that same outlook that you did. We're saying, March does not seem right. I'm not even sure May seems right at all.
Not based on what we know now.
No. But then once you get into June, then you're within that 6-month window of the presidential election. So it's going to be very interesting for Jay Powell to try to convince everybody, well, now's the time we need to cut rates. Right. See, I don't think it's going to happen. I think if they cut it, they're going to cut it in November after the election.
The Fed has both cut and hiked heading into and during presidential election. So there's not,
that's right.
It's not unprecedented, but it's often because they're already in the process. What none of us know, but there's at least one strategist out there, it's not me, saying that if they haven't cut by June, the inclination might be to wait. But I still think the data will be the decider.
Yeah, I agree with you, because I think Jay Powell's made it very clear that the data is the decider. I'm also in the camp that I don't think it's coming in June, and I think if we get it at all, it's coming in November after the election. I don't think it, in September, October, right before the election, I think it's going to be very hard to kind of, unless the economy goes off.
See, I think it could come in May or June, but not if the current set of circumstances are mirrored in the next couple of months.
That's right. So Thursday, we're going to get the PCE. Now, the PCE is their favorite inflation gauge. Right. And we both know after CPI and PPI last week, the PCE is expected to be elevated on a month-over-month basis, right? So, and I heard you today on with Charles Payne on Charles Payne's show on Fox Business, because you were talking about that, and you weren't necessarily so concerned, I think, if I heard you correctly, that an elevated PCE is really going to change a narrative.
Well, no, a couple of points I made. First of all, PCE, all the components you essentially have from the prior CPI and PPI report, which is why PCE, you don't tend to get big extremes outside of the consensus, because the inputs are essentially already there. You just have to sort of finagle the math associated with that. But I do think we're in a sensitive time market-wise, where even if you have a marginal difference relative to the consensus, hotter than expected, less hot than expected, it could move the needle a little bit more, not in terms of the market reaction on that day. I don't even care so much about that, but those day-to-day, minute-to-minute changes in rate cut probabilities. Everybody's probably now familiar with different ways you can do it, but the easy one is the CME FedWatch tool. You just put that in a search field and it brings up, you can go meeting by meeting, you can see what the percentages are. And those you can see the needle move pretty significantly. But the thing that is also important about the PCE, or really any measure of inflation, Powell obviously talked a lot about inflation in the press conference associated with the most recent FOMC meeting, but it was in the subsequent 60 Minutes interview that he did, that he's talked specifically about the 12-month change in inflation. Whereas in the past, he and other Fed members have sometimes focused on the 3-month change or the 6-month change. I thought that was interesting, because it's a more quantitative way to express this view that he's trying to express, is we want to give this time. We want to give time to the notion of long and variable lags, so we can really assess the impact of what they've already done in terms of the hiking cycle. So I think if anyone paying attention, economists and otherwise, we'll start to, when these inflation reports come out, you'll probably start to see more ink around those multi-month rates of change, given that, when Jerome Powell says this is what we're focused on, then we all should be focused on that.
Right. But I think that the idea that there's a lot of people in this business, in the financial services, whether portfolio managers or otherwise traders, hedge fund guys, that came into this business in 2007 when the world was imploding and every central bank around the world went to zero and some went negative, and then they kept them there for 15 years. And so this generation of people thinks, okay, well, this is normal. In fact, it's not normal. 5% is normal.
And not only is it not normal
in 1979, 1980, when you and I would just,
that wasn't normal either. Yeah, 18% interest rates wasn't normal. 0% interest rates.
That's right.
Isn't normal.
5% is not normal.
The Fed
it is normal,
as do other global central banks, that there were probably more negative consequences of ZIRP or NIRP policy, zero interest rate policy, negative interest rate policy on the part of global central banks. And I think, barring some incredible sort of financial accident crisis, I think to the extent that people think of the Fed put as the Fed will just go right back down to the zero bound with the next recession, or that, I don't think that is their bias. And one of the concerns was, if they stopped too soon hiking, that didn't leave a lot of ammunition to cut. Now I think they have a decent ammunition to cut when and if needed, without feeling that the bound they have to stop at is all the way at zero. And I think
I would agree with you.
Back to zero is a good thing, not a bad thing.
1,000%. But I think where we are right now is a place that they should stay for a little while longer. This idea that everyone's, they're stamping their feet. They have to cut. They don't have to cut. Look what the market has done. Rates have been 5.25%, 5.5%, and we're kissing all-time highs. Right. And actually, Barclays came out today, right before I came on. I saw a story that Barclays has one S&P estimate of S&P 6,000 by the end of this year, which would be a 28% gain from when we start. I'm thinking to myself, wow, that's fairly bullish. I mean, it's great. I love to be a bull, but I think that's a little bit
here, and somewhat on a tangent, as you know, Kenny, I don't do year-end price targets, in part because, frankly, I think they're sort of a ridiculous exercise.
Agreed.
And the example, but it is a way in the world of institutions, and our client base are individual investors. But in the world of institutional investors, it is a clean way to sort of compare strategists and pit one against the other. But the example I always use is 1987. You and I were both around in that, and I remember the crash very well. And at the beginning of the year, if I was doing that kind of prognostication and year-end price target, or what the return would be, and I said, not much is going to go on. The S&P is going to be up, 1 to 2% by the end of the year. Snooze fest. Well, even if I didn't say snooze fest, that might be the assumption. Not much. But man, the path the market took to basically do nothing for the year was extraordinary. And that's what matters more, helping investors navigate the ups and downs, not some calendar point in time to year-end calendar point in time, and wipe your hands and say, okay, that's how we're going to be measured. Well,
1,000%. But you're right, because in the demographic that you and I are talking to, that's not their world. It is in the institutional world. That's how they measure themselves, and that's how they say, I'm better than you, blah, blah, all that stuff. But on an individual basis, that's not what they should focus on at all. And that's what that's one of the things I constantly, when I talk to investors that maybe get nervous, or that they're not sure. Listen, this is a long game, right? We're not worried about the tick up and down between today and tomorrow. We're focused on about 3, 4, 5, discipline. 10, 20 years out, right? And that's what you have to get them comfortable with.
Yeah, I'd say probably the most common question I get from the media, not on a day-to-day hit basis, but particularly if it's a tough day or a week in the market, if there's markets in turmoil, special happening on CNBC.
Yeah, CNBC always creates the drama.
Times like that, one of the most common questions I get is, okay, Lizanne, what are you telling your $7 trillion of investors to do? To get in or get out? And I think, what a dumb question. Neither get in nor get out is an investing strategy. All
That's
that
right.
is gambling, and it's gambling on 2 moments in time. And
That's
I
right.
don't know any investor that became a successful investor by an all in, all out, pick a day. It just, investing is a disciplined process over time, should never
Uh,
be about any moment in time. And
Listen,
now
just
I'll
look at
jump off
Warren
my
Buffett.
soapbox and we
Warren
can,
Buffett is the example, right?
sure.
Of exactly what you talk about.
Yeah.
But you're exactly right. And it's funny that you say that, because yesterday Liz Clayman did exactly that to me when I was on with her. She said to me, "But aren't you selling anything? Tech's up so much." I go, "I'm not selling my tech." He said, "I'll die with my Amazon and my Apple." And I said, that's not what I'm focused on, right?
No,
We're
but
focused on the
you can
long
trim
term.
and add. I mean, that's the nature of
Correct.
rebalancing, is you
That-
stay in gear with more marginal changes. People
right.
think buy low, sell high. That almost infers all in, all out. Well, add low, trim high. That's what
That's
rebalancing is.
Well,
And it's a
and
beautiful
that's what I said
discipline.
to her. I said, you can manage risk by peeling a little bit off, but you want to have a core
Absolutely.
position. You don't ever want to let go of the core position. You can fringe around, trim around the edges. But like, am I selling my Apple because of that? I'm not selling my Apple, right? Or my Amazon or whatever it is, right? But it's about risk management. And I think that's also the conversation that I find myself having a lot with clients, right? When you try to get them to think like that, right? And look at the larger picture. Okay, look, I have
Look,
a ton of questions
it's
here,
hard.
though.
It
It is.
fear and greed are powerful emotions, especially when it comes to our money.
That's right. And
But it's
that's
our
exactly right.
job to talk about what really matters.
Right. And how you should react, right? Depending
Right.
again on who,
Yep.
everyone always says to me, well, what should I do? How far out in the risk scale should I be? Well, listen, we have to have a longer conversation. Where are you in the life cycle? What are your other assets? Who
Exactly.
do you have to take care of? There's so much
Exactly.
that goes into that conversation. I say to a
Exactly, which is
25-year-old,
another
you should
thing
be way out on the risk scale.
in addition to the get out question that I
Yeah,
bristle at. It's the, what are you telling investors to do? And I think,
right.
well, who's the investor?
Exactly right.
You and I could have a little birdie land on our shoulders and tell
Yeah.
us with 98% confidence, okay, here's what the equity market's going to do, here's what the bond market is going to do over whatever period, the next year. But what I would tell a 25-year-old investor that inherited $10 million, doesn't need it, doesn't need to live on the income, goes skydiving on the weekends, can handle a lot of risk, isn't going to freak out and sell at the first loss in their portfolio. That's one investor. Or a 75-year-old investor who built a nest egg, is living on the income associated with that, and can't afford to lose any of the principal.
1,000%.
So one near 100% conviction of what the market's going to do, because a little birdie from the future told me. But what I would tell those two investors are entirely different. So I always think shame on anybody who answers questions like that in some cookie cutter fashion.
And a blanket answer. Right. And I say that all the time. My daughter's now 31 years old and I'm helping her. She's managing. I said, listen, you need to be further out in the risk scale than I do. You're younger than me. You got much more time. You know what I mean? I'm on the 16th hole, right? So I got less time. But and I would say that to anybody, right? But to your point, it's not a blanket answer. You just can't answer it. It's not
because
the same
it's
for
also
everybody. Everybody's different.
Not just about time horizon. And
That's right.
So what comes into play there is trying to figure out before you learn the hard way whether there's a wide or a narrow gap between your financial risk tolerance, what's on paper based on time horizon, all those things,
Right.
and what your emotional risk tolerance is.
Right.
And sometimes it can be a massive gap between
Most of the time,
two.
there's a massive gap.
Yeah.
But
And
listen,
often
there's also a massive
we
gap
learn
between
the hard
husband and wives, right? The wives tend to be more conservative, the husbands tend to be further out. And it's always funny because when you send the risk questionnaire to both the husband and wife and it comes back, and then you have that conversation, right?
Yeah.
And it's so funny because it's always the same. The women tend to be, they want to be focused, but they certainly tend to be a little bit more conservative.
Kenny, smarter, more reasonable, more common sense.
Right.
Less. I'll go on, but not that I'm gender biased or anything.
Wait, so let's get on because I got a ton of questions and we're already half an hour into this. I want to get to some of the other stuff. We're talking about stress in the banking system, right? So we saw what happened certainly last year with Silicon Valley Bank. We saw the reaction to that. Now they're talking about commercial real estate and my God, the end is coming and blah blah blah. And yes, the other day there was somebody put an article out on Twitter saying some office building sold at an 80% discount. And this guy's his analysis was get ready because there are no buyers. I go, well, that's not true. There are buyers. There's a clearing price. Clearly down 80%, there was a buyer. There wasn't a buyer down 10%, but there is a buyer down 80%. And I think that there's plenty of buyers around. I think there's plenty of private equity money, but BlackRock and private equity money, even Al, right? At Kane Anderson is raising fund because he sees an opportunity. So I'm not necessarily so concerned that I think this commercial real estate market is going to absolutely send us over the edge. Do you have a different opinion on that?
No, I don't. In fact, our collective dear friend, Al, I'll sort of plug my podcast again. Our podcast is called On Investing.
He was on it, by the way.
He was on it. He was a guest, and we had an interesting back-to-back episodes because we had on Dolly Lenz and her daughter, at times the most successful residential real estate agent in the country. And then we had Al on to talk about commercial real estate. So it was a good back-to-back episodes on the broader real estate. And I started the conversation with Al by saying, here's my view. Tell me if I'm right, because I'm not an expert. I said, I don't view what's happening in commercial real estate as Lehman-esque. Sort of something's going to happen, the bottom falls out all at once. I view it as a slow motion train wreck. He said, that's right. That's how I see it. That this is sort of a hard landing scenario, but it's not moment in time. And a lot of people think when they hear commercial real estate, they just think of the office complex. But commercial real estate is a very broad category, inclusive of student housing and multifamily and healthcare facilities and warehousing. And even within an office, you've got different urban areas in terms of what the health of that industry. You've got Class A, Class B, et cetera. And then, of course, you've got a variety of banks and the shadow banking system with exposure with a wide array in terms of maturity dates and when debt is coming due. Hence, kind of still a train wreck, but over a slow moving way. And your point and the point Al made was like with any train wreck, slow moving or fast, opportunities are
there's
created.
Huge opportunity.
There are opportunities now for the buyers of this debt.
That's right.
Or the buyers of this equity. And you're starting to see many of those, funds get created. And so I think there is opportunity, but we're not past the pain point. Unfortunately, of course, many of the same small and regional banks that were disproportionately hurt during the mini banking crisis or whatever we're calling it back in the March period of time are the same ones with the outsized exposure. So all it means is as if you're a stock picker and you're looking either for landmines to avoid or opportunities, you got to have your fine tooth comb with you.
Yeah, but you also have that. You have to have a strong stomach as well, because I think that's exactly. And listen, it's the same thing in the stock market. People get emotional. The market has this visceral reaction, and then 2 days later, we're almost back kissing the highs again, right? Look what happened in October, right? They were selling it because the Fed wasn't going to cut rates. Oh my God, they took the market down, 12% in the Nasdaq, 9% in the S&P on October 30th, and then suddenly the narrative changed. And then they took it right up to all-time highs.
Well, because yields, that was a yield story. Yields went from sub 4, 10-year went from sub 4 to 5,
5%.
from late 5 to late October. That was the correction in the market. And then you saw yields go from 5% back down to sub 4, and that became a huge tailwind.
And they took it right back up. Right. So where do you think? You think yields are going back to 5%?
No, I don't, not at this point. I mean, I think it would have to be a turn in the trajectory of either the economy or inflation that is outside the current realm of expectations. But in turn, I also don't think we're likely to see a big move down in yields. I think a move in either direction would probably be a significant move in either direction, potentially troubling for the equity market. We are in this inverse relationship between, bond yields and stock prices, not on a day-to-day basis, but that's certainly a shift that has occurred over the past couple of years. That, however, doesn't mean that a big move down in yields would be a huge benefit to the equity market. I think a plunge in yields, if it happened because not just more disinflation, but a much uglier economic scenario, I think there would have to be a digestion point in the market. But what you're also seeing is that the move up and down in yields is having more of a day-to-day impact on the lower quality companies, on in small cap indexes and the
Right.
zombie type companies, because the impact of those moves in yields is much more front and center for them as they have corporate debt, especially down into the world of junk, coming due. But it's not as big a problem for the larger companies, and in turn, therefore, the cap weighted indexes.
Okay, but are you worried at all about the amount of funding that Janet Yellen has to bring to the market? This supply of treasury bills and notes and bonds that she's going to have to bring to the market. Again, it's the clearing price. There's plenty of buyers around for the debt. I get it. But at what price are they going to clear it? Is it right?
So far, it's
price,
not been, and that had been the big concern, the liquidity
right.
concerns, the fact that the Fed was no longer the biggest marginal buyer. But at I don't know, 4.5%, that's an attractive yield for money that 2 years ago had to go way out the risk
No doubt
spectrum.
about it. I agree.
So for now, anyway, I think there's ample U.S. household demand for treasuries. We're all concerned about huge deficits and the rising burden of debt, and I think that this is also sort of this simmering problem over time, this sort of slow motion train wreck, as opposed to some crescendo moment in time.
Right.
But for now, there is ample demand on the part of just the typical investor for treasuries with a decent yield.
Yeah, and I would think you're right, because like you said, a couple of years ago they were getting zero. Right now, 4.5% is very, very attractive, and on shorter duration, you're even above that. You're at 5.25.
That's right.
5.4 almost. 12-month CDs, you're getting better than 5. Right. My government money market fund is getting better than 5.
Right. That's right.
So it's all been very interesting. So talk to me about, let's just talk, because I know this, we could talk about politics and geopolitics, because it is a presidential
I don't want to
election
talk about politics.
Well,
I don't want to talk about politics.
No, but not politics that way. I'm talking about just how it can create short-term chaos, but it doesn't price stocks in the long term.
And
that
it's not
doesn't
just in the U.S. There are more elections happening this year around the world than ever before, and
That's
elections
right.
in countries that represent almost half the world's population. So
Right.
particularly after a year like last year with very little equity volatility, plenty of fixed income market volatility, but very little equity volatility, that alone suggests that the path of least resistance is probably up in terms of volatility. And could elections and the lead-in globally be a component of that? Yeah, that's sort of duh.
Right. But I'm just, it's interesting because a lot of people get nervous around what the political outcome could do to the markets and what should I do and how do I said, don't, you're not going to build a portfolio around what's going to happen in the election. You shouldn't do that. Right?
You should not do that, 100%.
While it creates maybe short-term noise and chaos, in the end, that chaos does, in fact, like everything else, creates opportunity when the market gets too emotional, right?
And you do tend to see movements more at the sector level as in the lead into elections, particularly if there either is already or is likely to be wide majorities where, significant policy proposals actually have a possibility of being enacted. That doesn't appear to be the case this time. So I think even the sector related moves are likely to be a bit more muted than would be the case particularly if you had, two non-incumbents and majority such that, boy, these policy proposals have a good chance of actually kicking in. And that's when you start to figure out, okay, what does it mean in terms of tax policy or defense policy or healthcare, whatever it is.
Correct. And now, listen, it's still early, so you could see some of that as we get closer, maybe to the election. More of that that might affect.
I wouldn't try to trade around it, though.
But no, absolutely. That's what I would say to people. Don't try to trade around it. Understand it, and put it kind of in your toolbox, but don't trade around it. I think that's certainly not the right thing to do. Talk to me about the S&P last year. I think we were 222. Here, I wrote these notes here. They were 222 for 2024. They're expected to be 242, which is up about 9%. And in 2025, they're expecting earnings of $271 a share, which is up another 12%. Right? So those are very robust projections.
They are. I wouldn't say they're very realistic. And I don't mean they're too high. I mean, they're not realistic. For the simple reason that analysts, I think, unique in this cycle, and there's vestiges of it from earlier in the pandemic when, because of just the incredible uncertainty, as you probably remember, from mid 2020, really until the end of 2021, you were running a record percentage of companies that had withdrawn guidance altogether.
Right.
I just said, we're not going to try to guide on a quarterly basis to some,
Right.
cents per share on earnings.
Right.
We have no idea. Now companies are providing more guidance, but not to the degree that they did pre-pandemic. And frankly, Kenny, I think a lot of companies may be using the pandemic, maybe excuses there's too negative a connotation, but you know what? No company runs itself on the quarterly estimate for earnings. That's not how they run their business, but that's how analysts come up with numbers. But I think what that's had the result of doing is analysts are they're sort of flying a little bit more by the seat of their pants. But as a result of that lack of definitive guidance, they're being nearer term in terms of the adjustments they're making to the out quarters.
Right.
They'll sort of wait for the earnings season to start. And then as they get commentary from the companies they follow, they might adjust the next quarter
or the
quarter after that, but not 6 quarters down the road.
Right. Which is
so that's
why
my
I do
point
think
about it not being realistic.
Right, which is, I agree with you, because, to project out to 2025 and say, 271 a share, you're right, I agree with you. It is almost.
The numbers are there because they have to publish estimates, but it's not really based on anything precise they're getting from companies. In fact, what's interesting about this earnings season that we're just concluding is in October of last year, obviously in advance of reporting season, the estimate was for about 11% growth for the fourth quarter of 2023. By the time the reporting season started, that had gone down to sub 2%, like 1.8%. But then companies started reporting and it was better than expected, and analysts had to kind of scramble and raise estimates again, and we're back up to 10% and change. So we sort of boomeranged round trip. But as a result of fourth quarter 2023 being better than expected, they've had to commensurately cut fourth quarter of 2024 simply because of the math.
Right.
Oh, well, now you're not going to have double-digit growth year over year because the comp is too much stronger than expected. So they're lowering fourth quarter of this year, not because there's some calamity expected. It's just, the quarter we're reporting was better, so therefore math says that I need to lower. So you have to understand.
Listen,
the game being played here to some degree.
I'm with you. I completely get it. All right, so let's talk about this because we're in 2024 and we wanted to talk about, the outlook for 24 and if there's this drawdown in the Magnificent Seven because they've gotten way stretched. Is it possible to consider that the market's not necessarily going to back off big because the other sectors, so whether it's healthcare, whether it's financials, whether industrials, there's plenty of opportunity. Those sectors have not gotten stretched. And so money can be reallocated. Yeah. Will tech come under some pressure? Sure. But it's not going to be a disaster. And the other sectors, money's going to move into these other sectors. Do you agree?
There's some interesting stealthy things happening under the surface of the market. Some really good, some not so good. An example of maybe the not so good is that year to date, the NASDAQ at the index level has had maximum drawdown from a year to date high is only 3%. Now, if you stop the analysis there, you'd say nothing to see here. NASDAQ's just been on fire. But the average NASDAQ member maximum drawdown from a year to date high just this year is minus 22%.
Right.
So there's a lot more going on under the surface, even within the Magnificent Seven, which the moniker was created as a definition of the 7 largest stocks in the S&P. Now, last year, they also were 7 really strong performers. They weren't the 7 best performers, but they were all in the top 50, top 10% of the S&P. That is not the case this year. You still have, NVIDIA and Meta, and I think the number 1 and 2 spot year to date. But Tesla is pretty much bottom of the barrel. And Apple is, I don't know, like 400th ranked stock year to date. And Google has been kind of quietly not looking great. So even within that small group, you have much more. Not only that, Tesla has been bouncing between the 9th and the 10th largest stock. Berkshire Hathaway leapfrogged it. Until recently, Broadcom had leapfrogged it. Eli Lilly had leapfrogged it. And to your point, you're getting sort of this stealthiness in areas like healthcare and industrials And I think that there are opportunities that are being created outside of just those names. And I think there
Right.
are opportunities. Now, I wouldn't sacrifice quality. I think
No,
you
no.
still want to stay up in quality when you go kind of down the cap spectrum. But I think that
Yeah, but you want to
there's
step in
more
quality.
dispersion.
Right, but you want to step in quality in the sectors that you want to be in. So if you want to go into healthcare, you want high quality, right? I agree with you. You don't want to go necessarily go down. You want to be at the top of the list, whether it's
Especially
basic
when going
materials
down
or
the cap
healthcare.
spectrum, because
Correct.
an index like the Russell 2000 still has about a third of its names that are some combination of not profitable or zombie companies, meaning they don't have sufficient cash flows to pay the interest on their debt.
Right. Right. And that's an issue that, that last point you made, they don't have sufficient capital to pay the interest. And so that's something that investors really need
And
to
in many cases,
be aware of.
interest, they've got debt maturing and almost inevitably are going to have to re-up at a higher interest payment. So,
Right, and
and those
that's the
types of
argument.
companies are being exposed with the return of the risk-free rate. They were
Right.
supported in the ZIRP environment, and now they're
That's
being
right.
exposed. I think the return
Right.
of the risk-free rate arguably means fundamentals and prices are becoming a bit more connected.
That's right. And so it's important, I think, for people to understand that point that you made about, the debt's maturing, but the debt that's maturing was at low interest rates. Now they got to reissue it at much higher interest rates. And if they don't have the cash flow, that then becomes the problem for a lot of those smaller companies or small mid cap companies, which is something that investors need to certainly understand, which is why, small mid cap, the percentage ownership in your portfolio should not be 25, 50% of the portfolio, right? It should be a
But
smaller
it's also,
percentage.
you can't look at large versus small or even sectors monolithically. When I hear people say, well, do you like small caps? And I think there's
Right.
1,850 stocks in the Russell 2000. That's not a
Right.
singular thing.
That's right.
So,
Right. Right.
there's even within the technology sector, which is always beloved or generally beloved, there are great companies in there and there are crappy companies in there. So,
Well, and it's a crowded trade, the Magnificent Seven, right? Because everyone was in, so it's a crowded trade. And this morning they were talking about the granolas in Europe, right? Now there's 10 stocks in Europe. They're not tech names, right? Well, some of them are ASML, but there's GlaxoSmithKline, there's Novo Nordisk, all that stuff. But they're talking about how those 10 names are also concentrated in Europe, and it's a risk because there's so much concentration. The same way the concentration was here in the tech names, these Magnificent Seven.
and by the
But I do
way,
think,
concentration in and of itself isn't necessarily a bad thing. These cap weighted
right.
indexes are often driven by a subset of larger cap names. The problem arises when, like was the case in June of last year, when you not only have a small handful of companies accounting for more than all the performance, but you have all the other stocks en masse dramatically underperforming the index. So it was the double whammy at the midpoint last year, where in early June, it was, I think, 12 or 13% of the S&P, only 12 or 13% of the S&P had outperformed the index over the prior, I can't remember whether it was 3-month period or 6-month period. So it was the extremes of both that was the problem. Having cap weighted indexes driven by some large cap stocks, that happens often. You just want broader participation elsewhere.
Right. And you have to know, or you have to be comfortable wherever it is you look, right? You do your homework. You can't just go out there, haphazardly and say, I mean, I guess you can, but
well,
that's not really going to help you.
As a passive investor, you're going to get the weight of an S&P 500, and that can work. But keep in mind that if there was no such thing as the S&P 500 at this point, and you and I decided to create an index of 500 stocks, and we weighted it like, let's say, like it was at midpoint last year at the most extreme.
Yeah.
They wouldn't allow the creation of that index. It wouldn't pass securities laws. Because of just the weightings. And what a lot of investors should keep in mind is that mutual funds are capped out at how much they can own of an individual stock. Even some of these sector exchange traded funds, the sector ETFs, have a cap on how much exposure they can have to any one stock. So you might think you're getting exactly the same exposure if you buy, say, a consumer discretionary, sector ETF. But at the point where Amazon was a third of that sector, and I think the sector ETFs are capped out at 24, you're not actually getting that exposure. It's more of a lesson around just understand what you're buying, what you own.
And that's exactly right, because you could be doubled up, right? In a name, you buy the XLF. I think there are two or three names that are at the very top. I mean, they make up 60% of the XLF or the XLK, right? And so a lot of people don't necessarily know that, or they don't understand that's what it's made up. And they need to do that.
These names aren't always the market darlings. Memories are
right.
short. 2023 was all about the Magnificent Seven and their dominance and performance. Well, 2022 was the opposite.
That's right.
They were a drag on performance. At the low in October of 2022, that was where the problem was. What was interesting at that time is there was positive divergences happening under the surface. Those big stocks were dragging the indexes down, but the breadth under the surface was improving. That's a great backdrop. But again, memories are short, and I think people forget that it can work both ways.
But a lot of people don't necessarily know that the breadth underneath is improving, because they get so focused on the big names. They see the big names are doing, and it creates that angst, right? That they don't understand that there's something else happening underneath, which is the role that people like you and I play, and wealth managers and advisors play to try to get that to get the word out there so people get more comfortable. Anyway, one more question, because then we're getting down to the hour here, so I don't want to go over the hour. But I had a lot of interest and a lot of questions just on people wondering about the emotional reaction to this artificial intelligence, and are we in this bubble? Is it everything they say it is, or is this another 992000.com, which I don't think it is at all.
I don't think it is. Is there hype, and are there excessive valuations near term? Sure. But I think the big difference between sort of the AI craze now and the .com craze then is there's more there. And in particular, the more there is in the denominator of the PE equation, particularly the forward PE equation.
Right.
Whereas the denominator wasn't really even earnings then. It was stupid stuff like, price
I'm
to
not even sure what it
eyeballs
was.
and,
I'm not even sure
price
what it was,
to pop.
because it wasn't earnings.
So that's the big difference. Now, when you have excess valuations, there is the hope, of course, that forward earnings are going to grow into those valuations. But it does set up a risk factor in the event there's a miss. Even with a company that continues to just power ahead with, quarter after quarter of better top line growth, better bottom line growth. I'm sure you can imagine one or two of the stocks I'm talking about, and I don't cover individual stocks, but the expectations bar then can get set high, where if, the last 3 quarters or 4 quarters have been triple digit beats, the 5th quarter is only a double digit beat. It's still a huge increase, but it's the better or worse can sometimes matter more than good or bad. Back to that argument.
Listen, when Apple came out with their earnings this last quarter, they earned $119 billion in 3 months. Right now, they took Apple down in the days leading into the report because everyone was nervous. Right? They go, China's going to miss. In fact, China missed. They earned $20 billion instead of $25 billion, and they took the stock down another 6% on the China. I'm going, wait a minute. They earned $119 billion in 3 months.
Better or worse, often matters more than good or bad.
I mean, it is funny level. But that's what happens, right? You get so worked up.
That's the nature of the market.
Right. Exactly. All right, well, listen, I so appreciate your time today. That was great. I love having these conversations with you, and I hope to do it again sometime. And thank you once again for taking the time to join me
I always love our conversations, both on and off camera. So thanks for bringing me into the loop here. Thanks, Kenny.
No, my pleasure. Thank you for doing it for me. Thank you very much. Ladies and gentlemen, thank you for joining us, and have a great day. And this is recorded, so this will be available to clients and anyone else that wants to see it at some point. So thanks so much. Bye-bye.